Okay, so first things first, everyone, welcome back. Always excited to be here with you guys. It really levels me up as well, because what you guys ask me, it puts me in a position and I know what content to put out for you guys, because we might assume that you guys know certain things, but if you don't ask us, we will never know. So obviously it's day 4, and this series was meant to introduce how I perceive the market. Moving into next month, it will be different, because then we'll cover certain topics based on your questions and so forth, and we'll take it from there. So let's get right into it. So first things first, what we're going to talk about is understanding Confluence, how to spot Confluence and applying Confluence to your trading. And we'll also do examples, and I'll also answer some of your questions basically. So before we get into it, you guys know I should do this disclaimer, because as you guys know, trading does involve risk. Everything that I basically state in this webinar is from my personal experience, how I perceive the market and how I take trades. So if you want to implement any of this that I teach in into your own trading, you should go back to your backtesting, collect your data, and then make responsible decisions, because we are all adults. Okay. Now, understanding Confluence. So Confluence is a powerful concept in trading that involves the convergence or the coming together of multiple factors or signals. So meaning when you take a trade, you don't purely just want to be taking a trade based on the confirmation candlestick. You want to see a few things fall in line together to actually set up your trade. Meaning before you even take a trade, there's certain things must fall into place to confirm that position basically. Now, this convergence creates a synergy that strengthens the trading signal and increases the probability of success. So like I just said, if you know, for instance, I'm looking for a demand zone at the low of the day, you know, these type of things, like I always say, each of the concepts I teach is a strategy on its own. But as we know, there's no such thing as a magic strategy or a magic bullet, basically. And if you basically compile the different concepts together, now you have that confluence to confirm whether that signal becomes valid or not. Now, these factors can include technical indicators, price action patterns, supply and demand, indicators, and fundamentals. It all depends on how you perceive the market and how and what your trading style basically is like. So then when multiple factors align to support the trading signals, it increases the confidence level of a trader as well. So what this means is whenever you take a trade, there should be no emotion attached, meaning you shouldn't feel excited, you shouldn't feel happy, you shouldn't feel greedy or scared, you know, all these type of feelings. You should kind of stay neutral. But confidence is obviously also a feeling. But what I mean by this confidence is if you know, for instance, you've taken this trade many, many times, it's based on data, it's backed by stats. When you take a trade, for instance, you will have confidence because it's based on data and not on emotions. Does that make sense? So for instance, how we also perceive it is, like I just said, you want to see confidence. Now, if I, for instance, have a market like this, let me just quickly grab my tools. So for instance, let's say the market moves down. As you guys can see here, we have our Asian session. So as you guys know, like we discussed in day 1, if price breaks above the high, we look for sells, below the zone, we look for buys. Now, let's say, for instance, the market does that. It doesn't mean now purely just because you see a low, a high, lower low, lower high, lower low, change of character. And now that means, okay, on this retracement, now I'm going to buy. Because now you're only backing it based off one confluence. So let me make an example of how that might look. So for instance, something like this, you don't purely just want to be looking at this change of character over here, marking out your demand, and then waiting for price to basically trace into that demand, and then basically trade, basically taking that buy, because most likely what will happen is you will hit a stop loss. So what you want to see happen, for instance, is something like this, for instance, where you can see, okay, we can clearly see that price has been bullish yesterday, meaning we have formed a high, a low, a high, a high. We had a break of structure. Break of structure left us with a fair value gap and a demand zone. Then we can also see that the market traded up, made a fake move end of day, and then left us with our Asian session. Now, when price breaks below the Asian session, that's our first confluence. Break below, we look for buys. See, first thing. Then Before taking a buy, it has to line up with something, what? A demand zone, second confluence. Then if you can see price taps into your mon and it gives you your change of character, now you have your three things, your break below Asia, fake move beginning of day, or your manipulation phase. Then you have the demand. Then you can also see a change of character. Now you can also see that change of character has a displacement or fair value gap, basically. Now you have four confluences. Then with that said, now you have demand over here, a new demand form, that's five. Then obviously also you want to see what your fib, whether that lines up. And then you have, for instance, 5 to 6 reasons to enter that trade. That's what I mean by confluence. It's the coming together of multiple things to support whatever direction you look to go in the market, whether it be buying or selling. And also, guys, just one more thing. Any questions you guys have as you go through this, ask me. Because if you don't ask anything, I will assume that you know what I'm talking about and you get it. But if you don't get it and you just keep quiet, you're obviously going to struggle. Remember, this is a safe space for everyone to learn. There's no such thing as a dumb question. The only people who never make mistakes are those who never try anything. So, by seeking confluence in the analysis, traders can increase the reliability and effectiveness of the trading strategies, leading to improved trading outcomes and greater consistency in achieving profitable results. Okay. So, identifying confluence factors. Now, obviously, the market is a very wide and wide thing which you can look at. There's so many different perspectives on how you can perceive the market. And I always say, almost any method that you trade can work, right? It all depends on the individual and their mindset. So for instance, even if you trade a completely different method to myself, your ideology as to how you perceive the market will obviously give you an edge based on your strategy. Sorry. So the first thing is technical indicators. This is one of the main things people use to obviously identify their trades, because this is how we do our analysis. So technical analysis, for those who don't know, is the studying of historical data in order to make real-time decisions. So technical indicators are mathematical calculations based on historical prices and volume data, providing insights into market trends and momentum. So examples of technical indicators include moving averages and Fibonacci retracements, trend lines. Now this can go even deeper. Let me just, okay, I'm not quite sure now if it's later on, but I'll mention it. Also indicators. Indicators is also a main thing that people use to identify trading opportunities. But here is my problem with indicators. Indicators are also backed on data. Now the market is very psychological, right? So seeing the market is very psychological, an indicator would sometimes what we call lag, right? So a lagging indicator isn't always a bad thing, because if you have the mindset of a market maker or the composite man, you will know how to take advantage of that. The second thing is, so there's just some examples. I'll obviously walk through my own, which I do, but just to give you a perspective, things you guys have learned, and just to obviously broaden the conversation as to what confluence is. So examples of this, like I said, is moving averages. So you have different types of moving averages. You have simple moving averages, exponential moving averages, which are called SMAs or EMAs, and others used to identify trend direction and potential support and resistance levels. So for instance, moving averages also, you are taught if price breaks above the moving average, you look for buys. If it breaks below, you look for sells. A similar concept to support and resistance. Also Fibonacci retracements. So based on Fibonacci ratios used to identify potential reversal or continuation levels in price movements, the Fibonacci sequence is something that is engraved into everything in the universe. So even your physical body, you can map it based on the Fibonacci ratio. A good example of this is, for instance, the length of your foot is the length of your elbow to your wrist. If you widen your arms, that's the length of your entire body. So that's a good example as to what the Fibonacci ratio actually is. So also with that said, so if the market moves a certain direction, a certain length, by putting your fib on there, you can get that golden sequence where price will then find a certain reaction on. But also because the market is manipulated, even the Fibonacci can be manipulated. But this is also why I've added different settings to my Fibonacci to also guide me when most people get trapped in the market, but I will also cover that, and maybe I'll also give you the settings. And also trend lines. So drawn on price charts to visually represent straight and the direction and strength of a trend. Trend lines is something that most people use, and this can also go in line with your other tools, support and resistance, your patterns, and so forth. Okay. Now, over here, what we have right now is basically a random chart with just some moving averages on them. But the reason why I've added this is to give you a perspective as to how I use moving averages and how you can also use moving averages to your advantage. So let's start off. Actually, just keep an eye on my chart, my screen. So for instance, you are told that if price, let's say for instance, let's focus over here where you can see this red line. Okay, focus on that for now. Let's say the market moves up. We can see price consolidates at this level. Then we can see a very strong impulse come through, a price moves to the upside. Then you can see price breaks, gives a clean break above the moving average. So here I have a blue moving average and a white moving average. So the blue one represents the 50 EMA, the white one represents the 200 EMA, the purple one represents the 800 EMA, meaning we have our water, mayo, and we have our blueberry. Okay, so you are taught that if you use moving averages, that if price breaks above the 200, and also those are the most commonly used ones, the 200 EMA, 50 EMA, and 800 EMA, and that's why I use them, because this is how I use it to also spot trapped volume in the market. So for instance, when price breaks above a moving average, you are taught to buy. Now, let's say, for instance, you execute a buy position at this level. What happens then? They teach you that your stop must go below the moving average, because the moving average acts as support or resistance. Now, let's say you put your stop loss either below your candle or below the next moving average. And also, like I said in the beginning, there is so many different ways you can perceive the market, different traders trading the market. They all trade different strategies. Some will use a 200 EMA, some will use a 50 EMA, some will use 800 EMA. So all these different indicators and things are all also meant to confuse the trader, or basically to have them trap people in different types of ways, if that makes sense. And look what happens when price breaks above that moving average. It clearly breaks and hits the stop losses. Now, let's say, for instance, okay, price now breaks below the stop loss, breaks below the moving averages. That means that we must now technically sell this market. Now, let's say, for instance, we now sell on the close of this candle. That means our stop loss must go above the high, above the moving average, or above the candle, or above the high. Automatically there, now you have 3 levels of potential stop loss. And look again what happens. Price just, you go into profit, yes, but as you guys know, human nature will always have people become greedy and they won't take their profit. So even like this over here, when you take this buy, you go into profit, strong move that obviously will induce you to leave your position in. And then basically with the break below, stops above, what happens then? You go to profit, but then price turns around, and look what happens, that wick. It wipes out those stops. And same thing once again. Let's say price breaks above the 200 again. You take your buys. Stops below the 200, stop below the other EMA, or stop below the candle. And what happens then? You go into profit, price holds. That kind of gives you confidence that price holding some sort of support. What happens then is price gaps down, stops them out. Very similar thing. Price comes back above, inducing many types of people. Buyer, 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 stop below, stop below, stop below, stop below. What happens then? Price moves, stops out. Once again, induces people to go long. And what happens? Market stops them out. So literally, once you can understand how to use moving averages to your advantage as well, it's game over. And I'll see if we do it in this session where I'll cover how I use it. But purely just want to give you guys a Confluence. Like I said, this is something, these sessions will run until the end of the year. So it's not like I'm really missing out on anything. Okay, so Sia, yes, I do use the Fibonacci retracement. We will get to that in the session, don't worry. Speak of the devil, Sia. So as you guys can see, this is what what the Fibonacci is. Now, as you know, the initial zone where price usually retraces from is usually 0.618. That is the golden ratio. It's usually 0.618 or 1.618. But as you guys can see, I have extra levels on here, which is my 705, which is stored by ICT, which is called your optimal trade entry. Then I also have the 0.786, which also becomes a zone where price reacts from. Now, initially, what happens is whenever I trade, I always look at my 705 and my 786 because this is strong zones. But then you'll also see that I have an 88% level over here, and I have a reverse Fibonacci. And this is basically my extreme zones. And as you can see, also, this is how I would use it if it doesn't add up, if let's say for instance, I have a demand zone at this level, right? But then I can see price broke above here and mitigated it. So this is actually, it doesn't count. So if I see that, I will know automatically that this zone doesn't count. However, there is the potential that you can enter here, stop below the one or stop below the low. But obviously, if you have the confluence and you can see, for instance, like over here, when we had the break of structure, it left a fair value gap. This doesn't count over here because this is what caused the break. So this is still an unmitigated demand zone, basically. And that's how you can then use the fib to determine at what level exactly you can start expecting that retracement to start coming through. Just clean this up a bit. And also what that said. So for instance, how I mark this out, obviously I'll go deeper into you guys with more examples, but the reason for this was because very, very simple. We can see that over here, this is where price changed character, right? Forming most of the upside, but then price was obviously, this movement obviously started at some point, meaning there was a low formed before these higher highs were formed. And that's how I then find my low to my high before I basically look for my retracement. Hope that makes sense. Okay, Jeff. Sam's asking Jeff, which Fib retracement ratio is used to identify continuation in price movements? So Sam, that question. Okay, let me quickly go. Let me see if I don't have a. Okay, here we go. So here you can see basically it depends, Sam. So what's going to happen is, you remember, market always has a trend. Now let's say for instance, this is your overall trend: high, low, higher, high, higher, low. So this is your low, and this is your high up here. So initially you can pull your fib from this low till this high like that. But also understand that you also have internal structure. We spoke about it last week. Your internal structure can also be used for your continuation. Now, let's say, for instance, over here, you can see here's your break of structure. So from this low up until this high, that is your internal structure, meaning if price then has to retrace, it has to retrace into one of these levels before continuing the upside, as long as it doesn't take out this low. Does it answer the question for you, Sam? Hope it makes sense. Okay, so then also identifying confluence factors. Okay, awesome, Sam. Okay, so also price action refers to the movements of price on a chart, reflecting the buying and selling activity of market participants. So price action signals may include candlestick patterns formed by candlestick formations such as dojis, hammers, engulfing patterns, and so forth, used to identify potential reversals or potential reversals or continuation patterns. Chart patterns are also formed by basically price movements on a chart, such as head and shoulders, double tops, double bottoms, triangles, trend lines. We also discuss it in our past sessions. So you guys can see how small things that may seem like, oh, it's nothing, but it actually plays a very big role, because like I say, if you can't spot liquidity, you will become liquidity. And also with that said, price action can also show you support and resistance levels, price levels where buying and selling pressure is expected to emerge, often based on historical price data and significant price levels, right? So for instance, what I refer to on price action basically is, okay, so I'll touch on this after I talk about this, but I don't want you guys to get confused on what I'm about to say. I always say this. There's two things I can't teach you. I can't teach you how to think. I can't teach you screen time. Meaning, I can only lead you to the water, but I can't make you drink. Because when you start doing your screen time, there's certain things you will start seeing happening on your charts. Meaning, you will start seeing how fast the market moves from your entry. You will start being able to anticipate after how long you should be in profit and when you should cut the trade. So by seeing certain things happen at certain times will put you in a position where you can anticipate what will happen when you're there at that current time. Because remember, there's two things that plays a big role in the market. That is price and timing. So if your timing is in at the right level, you should know what to start. You should have kind of know what to expect. Now, let's say, for instance, that we're on a downtrend. As you guys can see over here, as you guys can see, oh, sorry, let me just move this real quick. So as you can see over here on this check mark, that's where price formed our low. Then here basically is where price formed our break to the downside. Then on the top, you can see here's our supply zone where price formed the supply, obviously, with the fair value gap imbalance, whatever the case. So before price comes back there, price will, even though you're bearish, price will come there in some sort of bullish movement. So let's say, for instance, now we can see the pattern and we can see price is now making higher highs and we're heading towards this level. Now, let's say on this last break of structure, this candle opens and it pushes down. Because the break of structure is the demand level over here. Now, let's say this candle opens and it pushes down quickly. And what happens, it taps that demand and it forms a wick. If this happens where this wick taps it and automatically starts moving very fast into your supply and demand zone, you shouldn't be scared because the fast move is fake. And what I mean by that is if you see a fast move happening, usually you will start having the feeling of FOMO. You don't want to miss out. But what happens is when this fast move happens, I want you guys to go look at this as well. Notice how when there's, let's say you're waiting for price to come hit a level, and now it comes there very quickly. All of a sudden, let's say a 1 hour candle within the first 10 minutes comes to your zone. But notice how long it will stay at that zone. I've seen it happen many, many times within the first 15 minutes, price goes to your supply zone, right? And then for the next 45 minutes, it just stays there. It just hovers around there. And then the next thing would happen is something like this. And it closes. That to me, for instance, like this example I've just made is an example I've seen happen many, many, many times. So when I trade the market myself and I do my analysis, I'm waiting for price to come to my zone and I see this happen. I've seen it happen so many times. I have a certain anticipation as to what I can expect to happen moving forward. This is what I mean by your screen time. There's certain things you will start seeing price do so that when you see it happen again in the future, you can react on that based on that previous data and not on an emotion. Like I said, moves like this can cause FOMO basically. Does it make sense? Okay, so this isn't the best example I have here. I was looking last night for a clean pattern and for some reason I couldn't download an image. Okay, so please forgive me for this blurry image. It looked fine last night when I loaded it, but I kind of saw this coming. So actually, before we move forward on this, I'm actually gonna have us go to Google and just search Forex candlestick for reversals. So also, like I said, most people lose money because they come to Google and search how to trade Forex. All good, Christopher, don't worry, is recorded. So for example, you can choose, as you guys can see, there's a lot of things on here. So let's just choose this one, for example, the Candlestick Patterns Dictionary. Let's go to this website. Let me show you guys something. Let me see if I can zoom in a bit. So as you guys can see over here we can see all the different types of candlestick patterns. So they teach you about dojis, morning stars, bearish pin bars. I don't even know all these terminologies and all these names they have for all these patterns, because the thing is you can't put a name on them. You have to it's like, it goes back to what I say, people create these things for them to sell you something that sounds cool. But there's certain things like you can't put a name on it because it's based on data. Like you can only see it happen when it happens, basically. So you can go study all these patterns just for you to have an anticipation of potential things that might happen in the market, right? So this is just something that you guys can look at. So please forgive me for that, for this blurry picture over here. And then once again, I will also say this again, the patterns that most people use to trade to spot liquidity. If you see double bottoms, double tops, head and shoulder formations, breakouts, trend lines, pivots, you know already where people are going to put their stop losses. And if most people lose their money, you know already where they're going to get stopped out. You know where they're going to build liquidity. You know how to take advantage of that. Okay. So identifying Confluence for okay, we've already covered that. So fundamental analysis. So okay, I'm not going to go too deep into this. I will do a session on this in March where I'll be purely covering how I do fundamentals. But the whole idea is fundamental analysis involves analyzing the economic, financial, and geopolitical factors that may impact the asset, the price of assets. So examples of fundamental factors may include economic data releases, such as economic reports on reports on economic indicators such as GDP growth, employment figures, inflation rates, etc., which can obviously influence market sentiment and price movements. Then also keep an eye on central bank announcements. So meaning interest rate decisions is a very common one that we can look at. So statements and decisions made by central banks regarding monetary policy, interest rate decisions in economic outlook can also impact currency, because this is also what invites foreign investment into a country. If things aren't looking good in your country, high interest rates, people wouldn't want to come invest in your country, basically. Okay. Then also geopolitical events such as elections, geopolitical events, tensions such as wars, trade negotiations can also affect investor sentiment and market volatility. For instance, USD Rand. I'm very, very interested to see what's going to happen with the elections this year, because, okay, let me not take shots on anyone on this. But let me just say, if our current party loses, it will be very interesting to see whether the rand is going to explode to the upside or actually gain back its value. But also a quick one on that. I don't know how many of you guys saw this. The news event, well, not the news event, but the article that came out of the 228 banks that was involved with manipulating the rand. So since 2007 or 2008, they started manipulating the value of the rand. I think back then it was still 8 rand. So that means the percentages prices gone up is insane. So with that said, if it was manipulated in 2008 when it was still 8 rand, will that mean that the rand might go back to 8 rand? Just something to think about. Something to think about if the dollar crashes. So also the importance of aligning multiple confluence factors. It's essential to align multiple confluences to validate your trading signals and to confirm your trading setups. Meaning you always want to see your confirmation. You always want to see things fall together, because otherwise you are just blind taking a trade. You might as well just flip a coin. So then also by combining different types of trading a confluence, such as your indicators, your price action signals and fundamentals, you can then increase the reliability and the effectiveness of your trading decisions. And also aligning multiple factors helps you filter out all noise and false signals, focusing on high probability trade setups with greater conviction. So that's something that's not really spoken of as well, is when your own strategy gives you false signals. You have to be also to, so everyone tries to identify the strengths of their system, but no one looks at the weaknesses of their system. So if you hit stop losses, for instance, you also have to go back on your method and see what causes you to actually hit stop losses, basically. You're welcome to Bang. Check you later, my man. So yeah, you guys have to also look at that, the weaknesses in your system, and understand also why that has happened. And also when that happens, knowing that you shouldn't fall victim to that. So to give you guys a perspective on this as well, I've heard many people say, I go through a lot of hoops for me to confirm a trading setup. But that's because, like I say, my strategy tells a story. And if my story line doesn't add up, there's no signal for me to trade. So what I want to see is I ask myself when we trade. First things first, before taking a trade, as we know, we should buy low and sell high. Meaning I don't buy at the high of the day, I don't sell at the low of the day. I buy at the low of the day, I sell at the high of the day. I sell at the low of the week. I buy at the low of the week, sell at the high of the week. Buy at the low of the month, sell at the low of the month. Sell at the high of the month, sorry. Buy at the low of the quarter, buy at the low of the year, sell at the high of the quarter, sell at the high of the year. So whenever I trade, I ask myself, are we at the low of the day or the high of the day? Once I've confirmed we are at the low or high of the day, quick tip, it takes about 30 to 90 minutes for them to hold the high and low of the day for it to become valid. Okay, quick tip. Once I've seen that we've held the high and low of the day, I ask myself, are we at the valid supply or demand zone? If the zone is valid, perfect. Then basically what happens is, this is how I check them off. So are we at the high and low of the day? Yes. Are we at the supply and demand zone? Yes. Do we have a fair value gap or imbalance present? Yes. So that obviously confirms for the bigger time frame. Then also, do we have an institutional level at site? Yes or no? Yes, no, maybe, right? Backend, this doesn't always have to line up if you have other things lining up. Then also, do we have a fair value gap present that was caused by a shift candle? Yes. Are we in session? Very, very important. Yes or no? Do we have change of character? Yes. Do we see about a stop hand? Yes. That's the fib lineup. Yes. Once all of these things are met for myself, I know now I can take the position to the up or downside. If one of these things are not met, I don't take the trade. If we are not at the high and low of the day, no trade. If there's no supply in the demand zone, no trade. If you take a trade by not following your confirmation list, this is when you break your rules. And when you break your rules, there's no one else to blame but yourself. Because if you're trading a $10 account, why would the market maker be chasing your $2 stop loss? Understand my point? You know, so we shouldn't always be blaming everything on the market maker and the broker. We also have to look at ourselves because we are not perfect. Okay, you have to take responsibility for your losses. You have to take responsibility if you break your rules, because if you don't become aware of that, you're not going to change it. The first step towards change is awareness. Okay. Let's move on. So for instance, this is what I would like to see. I would like to see price in a certain type of structure. I would like to see if we're bullish or bearish. In this example, we are bullish. We can see that price has clearly made a high, pulled back, found resistance over here, break of structure, forming a higher high. So all the red circles represents higher highs. The green dots represents higher lows. Sorry, higher lows. Yes, sorry. So let's say, for instance, I can see clearly that I'm in a bullish market. I'm bullish. So that means I'm looking for buys. What I want to then see is Asian session come in, because I don't trade in Asia. Asian session comes in. And because I'm bullish, my cheat sheet that I gave to you guys last week states, if I'm bullish, I want to see price break below the Asian session or below the Asian box before looking for my buys. So as you guys can see over here, once I have this set, now I can start looking for my buys, for instance. Because most likely in a case like this, price will leave you with a demand zone. But also, I want to give you guys a perspective on this. So I added the EMA on this to give you guys a bit different twist as to how things could look. Now, first things first, remember when you have structure, your higher highs, higher lows. When price does this pattern where it moves up, finds resistance, pulls back, This is always resistance, there's always support. So support, sorry, resistance, support, resistance, support, resistance, support, resistance, support, resistance, support, resistance. Understand my point? This is all over in the market. So like I said last time, people will find supports from 1977 and base a trade off that, you know. Now, for instance, let's say this was a key level for most traders. They see that when price broke structure over here, that was resistance. What happens now? Price starts trading to the downside, low, high, lower, low, breaks through resistance. What happens now? Everyone is short. Also because the momentum for the day shows it's short. What else? Even price broke below the EMAs. That is their confluence, basically. But because we know the composite man's ideology, we now take advantage of that, for instance. So let's take it further on that. We know that, for instance, that there's demand zone left at this level. So when they go short at this resistance, we wait for our confirmation. So once we see price hold the demand, we want to see a reaction. So once we can see a change of character take place, now it must basically shift direction, basically meaning a displacement with a fair value gap. When that happens, for instance, now you'll see price form new higher highs, new higher lows. For instance, you will see over here, the price forms a high, break of structure. So automatically now, everyone now is buying. Why? Because they've seen, oh, price has broken above the resistance. Resistance has now flipped to support. There's resistance here. Price broke above that resistance. That is now support. And we also broke above the EMA. What happens now? We're supposed to be buying in this green circle. They buy there. What happens then is they put their stop loss below the resistance. But because you know that there is fair value and demand down here, you wait for price to basically trade back down into your zone, waiting for your reaction before taking your long to the upside. And most likely what will happen then is also once they get stopped out, this resistance, price will break back below that EMA. What will happen now? Now they're short again. They're selling again with a stop loss above this high. Your first TP. Does this make sense to you guys? Does this make sense? I mean, yeah, like I said last week as well, prove me wrong about the methodology, because it happens every single day. And even if we go to the charts after this, I will still show you guys that it happens every single day. So let's quickly clean this up a bit. Awesome, awesome. So here's a very good example. Here we can see Euro USD. This was actually on the 7th of Feb. Here we can see price. Okay, so if you go further back into time, you'll see what happens. So you'll Sombulala, he's asking on which time frame does this occur mostly. I only use my 4 hour to do my analysis, my weekly. When it comes to my structure, for my Asian session, my 15-minute chart. 15-minute chart is the chart. If you take your 15-minute chart, right, and you mark out 12 o'clock beginning of day and 12 o'clock end of day, and you zoom out just enough, you will see that the 15-minute chart gives you a perspective where you can throw up the entire day, just a day, and you can see exactly what happened. And exactly if you go in the 15-minute chart, you map out each day beginning to end, Monday to Friday. So Monday, Tuesday, Wednesday, Thursday, Friday. And you also zoom out and you adjust the high and low. You can also fit it perfectly into your screen. Then you can also see the entire week's data. So that is why the 15-minute chart to me is very, very important. I'll actually show you guys now when we go to some live charts. So this is something you can go study on your own. On the 7th of Feb, price came, it was just after news, price formed change of character around this level over here. Change of character, break of structure, break of structure, break of structure. So we are clearly bullish. Now, this was the 7th over here. Let's quickly mark it out for you. This was the 7th over here. Now, with that said, now you have the low of the day of the 7th, and you also have the high of the day of the 7th, right? Asian session comes. Now, as you guys know, we don't trade Asia. Here's our Asian box over here. as you guys know, want to see price break below the Asian box before looking for buys. And what happens now is, as you guys can see, price breaks below the Asian box. What happens now? Price is broken through through support. Everyone is now short on that. But also before that, price has broken below the EMAs over here, meaning there's also people short over here at this position. So the sellers there stops above. The sellers here stops above. Also, price breaks below the EMA. So the sellers here stops above. Yeah. Then also, then obviously from here on, you're going to implement your FIB, for instance, and see how you can get into this trade, because now you're looking for demand. Now you can see over here, this is the low of the previous day. So that liquidity was swept. And what did price leave us? Just clean this up a bit. You'll see over here then, here's our 705, our optimal trade entry. Then you see this is where price has broken structure at this level. Also internally, also look at that. So this 50 EMA, this blue line, notice over here how price has broken structure here, forming a high. So this is the demand price has left, which is unmitigated. And also here's the EMA that indicates that there's a lot of volume there because there's buyers and sellers. So people who bought there, sold here, bought here, sold here, bought here, sold here. The question was who was trapped, buyers or sellers. In this example, the sellers were trapped here because they were following the news event where price was bearish. Then with that said, when price started breaking to the upside, breaking above the EMAs and coming back, now they were all long. Everyone was long and who bought even above this level had stops here. So this is why this happened, taking out all the buyers basically. I hope that makes sense. Let me just go deeper into this. Did I not? Okay. Sorry about that. I didn't add the last slide. But you guys get the idea, basically. You always want to be looking at all the points where there was potential liquidity, meaning the high and low of the day, the high and low of the week, high and low of the quarter, high and low of the month, high and low of the year, because these highs and lows, if you think about it, if you think about structure itself, if price, oh, if you think about structure itself, why is it doing this? There we go. If you think of structure itself, let's say, for instance, you look at the market that did this. I can guarantee you, doesn't matter what happens, this was most likely the high of the day, the high of the week, high of the month, high of the quarter, or high of the year. This low where price took off will either be the low of the day, low of the week, low of the month, low of the quarter, low of the year, and so forth. So whenever these reversals take place, take note of whether they're at the highs and lows of the month or year, because that's where you can spot liquidity. Okay, guys, feel free now to drop all your questions in the chat and I will start going through them one by one. So we'll start off with Keenan's question. Can I touch on the yellow D and high of the day made within the first 90 minutes of the day? Feel free to drop those questions. Just give me a second quickly. Okay, so let's flip. Okay, the stop here on GU, but I'm at least blue on gold. Stop to break even. Okay, let's look at oh man. Okay, so let's look at this real quick. Let's go back into time. Let's just look at last week. Last week Monday. Okay, so over here. So Asian session from 12 to 8. So as you can see, here's our Asian session. Okay. Now, with that said, for instance, we can see that, okay, we obviously have to look at structure itself over here, but just to give you guys an idea, I'm not going to go too deep into it. So just the ideology itself, Monday, Tuesday is over here. So here we can see price trades to the upside. Let me just map out 9 o'clock as well for London session. So automatically Asian session, you guys would see when price was trading around these highs, price was at the high for 1 hour, 30 minutes, right? So Keenan, just that already there, your Asian high and low. If that has been yelled, obviously that's your zone. So as you can see, when London came, that's why it yelled it. Now you'll see also over here, when price started, okay, so obviously you shouldn't get confused with this. When price came down, forming this level, obviously this was your low of the day. But then you can see this is 15 minutes, 30 minutes, an hour. This is about an hour and a half. Then you can see an hour, 45 minutes, price broke below that, so it doesn't count. Then you would see also then in, okay, but here's the other thing, the timing is out. So from 3 o'clock up until 6, my strike zone, it only came here, yeah, around quarter two. Here's the other thing, also your line chart. So when price started forming this over here, you can see, okay, just to give you a perspective on that, obviously here is demand, here is fair value below it, here is more demand over here. So price didn't come to this level, however, it's trading within this demand zone over here and it's holding it. So as you guys can see, price didn't break below this demand level over here. It didn't break it, it just held it. Then in this demand level from here till here, we can see that already there's 2 hours. So that is how you must base it, if that makes sense, Keenan. I hope that makes sense. So you want to see them basically hold your demand to supply zone for 30 to 90 minutes. They shouldn't break straight through your supply demand zone, because then automatically they invalidate it. Okay, does it make sense? Let me know if I should cover it again. And Sam's asking, Jeff, is it possible to include my material in the future, to include the impact of big company earnings in the outlook of future assets? Okay. Okay, yes, I can definitely do that. Actually, Sam, that's actually why I didn't do it today, because the way I do fundamentals, it's different. I usually look at companies and I use it based on news articles, speeches, company earnings and stuff like that. So definitely, I will definitely do that in March. No date yet, but you guys can just keep an eye on the topics. Okay, then how do we spot fake outs? You've battled with this in the past and you've been caught out. It depends on how you want to refer to a fake out. Because if you look at what I teach, if you look at day one alchemy, if you look at the Asian session itself, the breakout there, the fake move beginning of day, that is the first fake out you can spot using your Asian session. That you can also use. So here's okay, that's something I'm gonna, because my mentorship, I'm not gonna give it away for free. But actually, no, it's on my YouTube. It's on my YouTube. The weekly structure, go check that out. How you can spot weekly fake outs. So the Asian session, 15-minute is how you spot daily breakouts or fake outs. And the weekly structure is how you can spot weekly fake outs. So go check on my YouTube channel, the weekly structure. I will also do a session on that in the future. But the whole idea behind that is basically very, very simple. How you spot the weekly breakout is you look at your Monday Asian range. So your Monday Asian range will be your first 2 hour, your first 2 4-hour candles of the week. That is also your weekly Asian range. And same concept, if it breaks above, you look for sells that week. If it breaks below, you look for buys that week. But then on the weekly structure, breakout and fake out, your entry might only potentially come Wednesday, Thursday, because that maps the weekly reversal. But just a gem, go check it out and get back to me on that. Okay. when I'm looking at the charts for practical sessions, can I include USDT as one of the examples? Sam, I will definitely do that for you as well. I will definitely do that as well. Mange, market sessions by Levathian. Okay, I will check it out. I will check it out. Thank you. You're welcome, Sam. You're welcome. Devin, I've been trading my method for about 2 to 3 months now. If there's one thing you can say, it's always consistent. You always consolidation. Wait, let me read it again. I've been trading method for 2 to 3 months now. If there's one thing I can always say that's always consistent is whenever I entered, I'm always hit the consolidation in my zones. Yeah, because in the end, Devin, you also want to be waiting for your confirmation pattern. So obviously, when price comes to your, let's say you have a demand zone, price will come there internally with a bearish structure. So that bearish structure must first flip bullish, and with that coming down, it will hold for a few minutes. That them setting up the reversal is that waiting period, basically. This is why there's no need for you to rush into things, basically. And also that 2 hours. Why I say 30 to 90 minutes? Once you're in the trade, you should be in profit within 2 hours. If you're not in profit and price still at your zone, reset the clock and give it 2 more hours. Within 4 hours, if you're not in profit until the break even, cut the trade, scratch it. Okay, so Sia, how do I use the line chart? The line chart, very, very simple. I use it to spot liquidity as well. So a line chart is very simple. This is why I say the line chart is where you can see the true support and resistance. For example, if we look at this example over here, we can see Asian session technically ends here and technically ends over here. So if we put it back on candles, now you can actually see the wicks. And the wicks do what? The wicks indicate trapped volume. So this is how I also used to do my support and resistance. So that will be my resistance of the wicks, and this wicks at the bottom will become my support. And even so, you can see how price reacts at these levels. So the line chart is definitely your friend. Another thing, for instance, what I use the line chart for is let me quickly run you through why I took gold. So very simple. On Friday, the market just exploded. I mean, this was a perfect search and destroy day where they broke below and they just moved to the upside. Fake move beginning of day, they ran to the upside. Fake move end of the day, they pull back. Asian session starts. What do we have? We have a gap at the open, and then also we have a supply zone over here. Let me just double check that. I don't wanna. No, I'm wrong. Sorry, I'm wrong. So we had the gap over here. I want to see the gap be filled. Once the gap was filled on the 5-minute, how they filled it, or let me actually go to my 15-minute. Yeah. So how they filled the gap over here, this candle, notice with what force it came back to close into that level, and it closed back below the Asian range. So that to me was my indication that price is now going to flip bearish. Then also not just that, looking at structure, we can see high, low, higher high, higher low, higher high. Here's our low, price broke below that change of character, right? Well, that change of character that took place, I think it was, yeah. So what happens now is, if you can see internally, we can see bearish structure, meaning we have a low, a high, lower low, lower high, lower low, lower high, lower low, higher high. When price broke above that level, that's when I place my fib on here. And then you can see the 705. There's my supply zone. Let me just clean this up. So that's when my price left the supply zone. But if I go to my 15-minute chart, sorry, I'm just gonna double check that. My 3-minute chart, this wick which price left. So you'll see if I draw my fib again, that 705 lines up perfectly with my supply zone on that wick. So then all I had to wait for was wait for price to trade into that zone. And I had my sell limit at this level. My stop was 17 pips. And I'm targeting the Asian low. So as you can see, a nice risk reward of 1 to 5. That's basically how I took it. Let me just go through. So Sia, did I answer your question regarding the line chart? And Sam, can I go through what I just taught us, how to confirm? Okay. So for instance, on gold, very good example. Why I took gold was because my 15-minute chart, when price broke above Asia, here's my first breakout. Or well, also look at the timing. So 9 o'clock over here. This is when price first made that wick. So when price first tapped it, notice over here, price held it first for an hour. Then that last half an hour, price made a fake move in and out. So they ran it for 30 minutes, ran it for so that is an hour and a half. It came back into the Asian nation. That confirmed to me that my zone has now held. What else did I take? I also looked at, let me quickly run back to that GU I took. And you'll also kind of explain why I took a loss on that. So over here, for instance, I purely backed this GU trade of this demand of this supply zone over here. Now, also, I wouldn't say I broke my rule. However, I just backed it on something else. So for instance, initially, I want to see change of character take place over here. But then I backed it because price formed this high over here. I then saw change of character over here, which was my mistake. I should have stuck to my initial rule. So as you can see, change of character basically. And when price came back into the zone, I entered more or less around here, right? So I went to profit, but unfortunately, as you can see, I was in the blues, but then I didn't adjust my stop because only once, if I had a close like this, for instance, below, I would have done this. Then I would have been in risk free. But unfortunately, the market didn't do that. So once again, it just comes back to having your rule set. And also another reason why I didn't hold is because once again, I didn't give it the time to breathe. Price didn't hold this level for price was literally only here for 30 minutes. So as you guys can see, I also still make mistakes. I'm also human. But in the end, it's like I always say, it comes with experience. So I've taken trades like this before where it plays out exactly like on gold. Gold played out, so just one of those things. You won't always be right, but this is why your risk management plays a very, very big role with your trading. Okay. So Devin, I would say like mastered. The only reason why I'm on the 3-month 1 month is because I've mastered that time frame. So that's the only way you can actually get to that level is if you go and study that. Okay, let me just take some partial profits here on gold because I see we might actually reverse from this level. Okay. Okay, Sia, glad I answered that for you. And Sam, what I just showed you now on gold and GU, does it make more sense based on what we just covered? Also, that's also the other thing. On GU, it was fucking dumb mistake, I'll be honest. Also on gold, why I took it is also because my weekly open lined up. So I also had Confluence there. Okay, so Keenan, in regards to liquidity taken, if a line chart shows liquidity grab, I would say it's hard to say on a line chart if liquidity has been taken, because the reason for that is you can't see the wick. And initially, how I see liquidity taken is like something like this. Like, check this out. Notice this wick. So notice this big candle. Remember what we say, people get induced. So take a look at a candle. So what happens is most likely we had something like this over here. Yeah, trend line. So that means, let me just actually go a bit deeper into it. So this is how I use a line chart. I use it to actually draw my trend lines. So you'll see something, okay, something like that. So automatically, if you want to perceive it this way, if there were people with stop losses here, is if people with stop losses here, people would buy stops, prices goes there, it taps them and then moves. But if you put it in a line chart, you don't see anything. Does it make sense, Keenan? So your line chart and your candlestick chart plays a very big role. You use your candles and your wicks in your candles to basically spot. Like think of it this way. Think of it this way. You have your candle and you have a wick. If that wick pulls back, like literally see it as a hand that went there, grabbed orders, and literally pulled back basically. That's the best way I can describe it. Yeah, definitely. Definitely. I mean, look at this, Sam, eh? Look at this. The stop on gold was 17 pips, right? I'm in break even. I am now up 40 pips. On GU, my stop was 8 pips. My TP on GU would have been 34 pips. So literally, when gold came here, when gold was here, I already technically made up for GU. You know, so trading is very, very powerful once you have mastered this. So what I'm going to say is, guys, as well, before we end the session, there's a lot of value I share with you guys, as you know, obviously, but I can't share all my secrets with you guys. It will be unfair towards my members. So you guys, most of you guys are obviously from the chat and so forth. If you guys need mentorship, hit me up. I can give you guys discount. I can do 25% off. If you can't afford the entire package, we can work out payment arrangements, because I know also you not everyone just has money to throw around like that. But in the end, don't think, oh, Jevon's charging us. I charge for my time. You know, I put in the time to teach you guys. I put in the time to put things together for you guys. I charge for my time. I could be analyzing charts. I could be working something different, you know. So in the end, I do this for you guys. So see ya, it's 4,400 Rand. But if you, obviously for you guys, like I said, if you're from the chat and if you come from Vault Markets, 25% off, that will be 3,300 Rand. It's a once-off payment. There's no hidden fees with me for life. There's no like admin fees and stuff like that. Literally, the fee you pay me, I perceive it this way, is your commitment to your trading. You pay me for my time, you respect my time. And also, if you pay for something like that, you're gonna value it. You're gonna value it. You're not gonna be wasting both of our time as standpoint, because then technically you've wasted money. So there's other things also I want to share with you, but like I said, it'll be unfair towards my members. And these are unfortunately the things which which are not taught on Google. These are things that my mentor has taught me from, okay, I'm not even gonna go there. But yeah, guys, that's it for the session. Like I said, I hope I answered everyone's questions. Any other questions you guys have, feel free to message me. There will be an update on next month and what we're doing moving forward as well. With the topics, it won't. This is your basis. Day 1 to 4 is your basis. If you don't study this, then everything in the future I put out, it's going to be useless, because there's no such thing, like I said, as a magic bullet. It's understanding the ideology and structure. If you understand the ideology and structure, you can then formulate your own strategies. Most of the things on here as well, yes, I've taken a mentorship. I'm friends with people who do mentorship and so forth. But I always find weaknesses in systems other people did. I find weaknesses in systems I didn't build and exploit them. And that's how I became profitable in trading, because if majority of people lose money and it's a scam, just do the opposite. And that's what I did. You know? Awesome, Sam. Awesome, man. I'm very, very glad. Exactly, Christopher. Exactly. I'm very glad you guys enjoyed it. This will definitely also go up on YouTube. Like I said, please like and subscribe, share my channel with